All right, and welcome to the LTA Concepts first edition. We call this the Alpha Edition, the absolute framework necessary in order to set the foundation of LTA concepts. It's a completely different way, a new way of approaching the markets. This is a new journey, a committed journey we're going to go through together in order to get where we want to be. And that is, of course, becoming a profitable trader. We can talk all about how 95% loses. We can talk about all the flaws, all the mistakes I made. And we probably will talk a lot about all the mistakes I made throughout my 7-year journey so far. Just to talk quickly, have a quick briefing about who I am. If you don't know who I am specifically here. Okay, my name is Lorenzo Corrado. I've been hosting live streams on YouTube for the last 2 years, where I've been trading for a significant amount of time longer here. Yet, for the last 2 years, I've been trading live on stream. I have been trading for the past 7 years. I've been trying and testing out practically every single strategy, tool, indicator, you name it out there. And of course, this came with a heavy price. And the heavy price was obviously wasting a lot of valuable time, yet creating all the perspective needed in order to come to the conclusion of what is working for me right now at this particular moment still. And that is the creation, of course, or that result that I can better say, into the creation of LTA concepts. This concept represents the strength of our community, all right? Limitless Trading Academy, our people in our Discord, our core traders, and everyone else involved here helped us tremendously, including our team, with the creation of LTA concepts. So I'm extremely blessed to be here to represent LTA concepts as of what it is right now, the first edition. What is an absolute necessity is that you went through the 74-page ebook, our first edition ebook. If you're going through the LTA concept series a little bit later, we might have already released our second edition. You name it, but more and more is coming here. It's a fantastic way of getting familiar with the LTA concepts, as well as making sure that you have at least a clear basic understanding of what we're going to talk about, because in this video series, in this full-on lecture series, we're going to cover a lot more specific trading examples, a lot more practicality, a lot more context, a lot more feedback based upon the results and the feedback we got from our community. We have been making sure that we listen, we observe, and we improve, and we build around that. This sets the framework right now. This provides you with even more context, and this will make sure that you have an extremely clear understanding here. I'm not here to sell you a dream. I'm not here to sell you the dream, okay? I'm going to be as logical and realistic as possible, because this strategy is built around pure logic. It makes sense. You will understand why. It's not subjective at all. It makes a lot of sense, and we're going to cover every single part of that. So in this part specific, we are going to dive into the volume profile, the key battleground. Okay, we're going to talk about the value area high, the value area low. These are called value areas, and the point of control. These determine to help us with finding incredible key levels, which we can utilize later on. The basic foundation is going to be, of course, the definition around this tool, around how we can utilize it, around how LTA concepts got born, how we found out what works, what doesn't work. We can provide you with much more context here in a slide, but also, of course, on TradingView. So you will probably have an experience of 50% slides, 50% TradingView with some examples. Okay, now let's dive into the introduction to see what we can expect here. So number one, we will talk about the definition of volume. This is going to be a volume-based strategy. You will see why this matters so much throughout our journey and how we can utilize this, okay? The definition of volume is in many cases completely misunderstood. There are a lot of misconceptions about volume, how it works, what is it, how to utilize it, and what type of volumes are out there, because there are multiple different ways of understanding, and multiple different ways to approach volume and to utilize volume when trading in general. So this is going to be an absolute measure, an absolute necessity. Then we're going to talk about volume and price versus volume and time. There are two different ways of observing the markets here. You have the way to look at volume and price, and you have a way to look at volume and time. Volume and price and volume and time can be also used simultaneously. We can also find a sweet balance there, utilize it in the right direction, in the right way. But again, this will all come throughout this series here. Then we're going to talk about why volume analysis is considered the pinnacle of trading strategies. And I'm going to come with a lot of arguments, a lot of facts, all right, why this is used primarily by institutional traders, proprietary traders. The pinnacle of this industry in general is utilizing volume as one of their key measurements of understanding the markets. So this is extremely important. And then, of course, we're going to talk about the fixed range volume profile. Now, let's start out with the definition of volume. Because what it in essence is, all right, it's a representation of the total number of shares or contracts traded within a certain period at specific price levels. You have the bids, you have the asks. If you want to buy something from somebody else, then somebody has to sell it to you. So somebody is willing to sell it to you for a certain price. If you want to sell something, then you want to sell it to somebody who is interested in buying. Keep in mind, again, it's player versus player. It's not all fun and games putting money into a big pot and that's it. No, you have to buy it or sell it to somebody else in order to get what you want. And that is the agreement. That's the contract or share you're looking at. Okay. So again, volume represents the total number of the shares or contracts traded within a certain period at specific price levels. This determines how much volume is in the market here. How many contracts are actually traded within a certain period of time. Market activity and liquidity is key here. There is kind of a misconception, and we're going to talk about this in a second here. Okay. But what it indicates is the level of activity and the ease of executing trades without significantly affecting the price. So the more volume, right, the easier it can be in terms of, not being able to move price. The more liquidity is there in the markets. Therefore, when there is more liquidity in the markets, you will probably have less of an impact of price regardless. We're talking about a $6 or $7 trillion daily turnover in the markets already in the Forex industry. So the chance that you will even have a remarkable, chance of potentially manipulating price here is practically already slim to none. However, it is important that there are differences in market activity and liquidity, and therefore sometimes there is there's high liquidity in the market, sometimes there is lower liquidity in the market. That means that, for example, when big players are entering the market here, that does not necessarily mean that there is more liquidity for you also available, all right? And this comes as an extremely important factor and is also determined initially or eventually what kind of commissions you will have to pay. What are the spreads that you have to pay in order to get what you want for the price that you initially were looking at for, all right? Very important that there is enough liquidity in the market in order to get, in that sense, what you want here. If there is not enough liquidity in the market here, you might pay a significant amount of fees in order to still get into your position here, which could have a major impact on your overall trading. But we're going to cover this later on. You have high trading volumes, okay, suggesting strong investor interest. So the higher the trading volumes, the more investors or people are interested at specific price levels in the market to protect themselves. So this could be aggressive sellers. This could be aggressive buyers, okay? The difference between aggressive buyers and aggressive sellers is what we call the delta. That's the net difference between aggressive buyers in the market and aggressive sellers in the market. When there is a strong investor interest, this usually reflects into high trading volume, okay? This is usually associated with higher liquidity and automatically easier trade execution. But again, this does not have to be the case here, because if there are only a couple of very big players in the market, they usually do not leave gaps for you to get into the market easy, and this could still increase, the slippage, the delay of execution because of heavy, strong price movements in the market. When it comes down to low trading volumes, this indicates, of course, a weaker investor interest, and automatically the price moves may be less significant and more likely to reverse. All right. When there is low volume in the market here, there is a lot more chance of course, manipulation, as well as on the high trading volumes. The only difference is that it doesn't take that much volume, that many contracts traded in order to reverse price, as when the trading volume is high. It's much harder to reverse price when the trading volume is high than when the trading volume is low. That makes sense in that matter. So let's talk about the misconceptions about volume, because there are a lot of them. And I think it's important to get this out of the way before we even start with everything that we need to talk about here. Number one, high volume does not direct or equate your liquidity. The bid and ask spread is what matters. All right. So I already covered this beforehand. When there is high volume and it's only managed by a couple guys, a couple of massive players in the market here, they doesn't leave a lot of room for you to join along the way here. So without further ado, the bid and ask spread will be much bigger. There is always a small gap in between the bid and in between the ask. And especially when you're trading with Forex brokers here, they can determine, of course, what that spread is. So it's very important for you to pick the right broker. I'm not going to be here for you and promote a specific broker to you. This is what you have to figure out yourself, but it's an absolute necessity and key that you do your proper research and that you understand, what good brokers are and, of course, what bad brokers are, and how to reduce this specific spread amongst, certain moments in the market here. There are, certain moments where the spread is significantly higher due to an opening of the market here, or due to, of course, less liquidity available. For example, during Asian sessions, we do have scenarios where there is less liquidity, especially later on. Okay, if you trade the Asia, you have to be extremely aware of what the current spread is, because you do not want to be in position here. And if you say I risk 1% of my trade, you don't want to be in a 0.45% spread by default, right? That's going to massively impact the trading. And therefore you want to make sure that there is a significant more liquidity in the market here. So to conclude, high volume does not equate directly to high liquidity. Okay, it's very important that you understand the difference there. Now, when it comes down to, of course, the opening and closing sessions, the volume is different throughout different sessions here. So, for example, when talking about New York obviously has significant volume. The New York Open usually refers to high volume. London Open usually, and it depends on, of course, which instrument you trade, but it also can reflect towards high volume. Okay, so it's very important that you are always extremely aware of these opening and closing prices of the market here. If you are completely new to understanding what the opens are, we can talk about this later on as well. It's in the ebook, but at the same time, what you can do on Google, you can go to the Forex market hours. You can find exactly all the right opens and closes of the market as well here. But I highly recommend you to check out the ebook and to look at every single open out there. It's super key. It doesn't matter if you trade futures or if you trade Forex. It's an absolute necessity that you understand when these opens occur here, so you exactly can set yourself by default already in the right position without putting yourself into a vulnerable situation where you can get manipulated because you didn't know that the opening was exactly around that time here. So it's a very important moment that you understand that every single hour matters in the market. You want to know exactly what current stage or what's current session of the market is. You also want to be aware of the fact that you do not want to trade too many different sessions out there if you are a beginner trader. I highly recommend you to start out with one particular session to get familiar with that session, and from there on try to move along here and to test things out there. I also highly recommend to not be obsessed with 20 different instruments at the same time, at least not the first time you are trading. The more advanced trader you become, the more and better overview you have, the better you can divide your overall focus upon multiple different trading instruments here. I highly recommend you to start slow and to scale it up over time whenever you get the opportunity. Trend confirmations misunderstood, okay? High volume does not always confirm the current trend, and it can signal reversals. So whereas low volume, like we said before, can signal also reversals, it's easier to reverse price when it happens when there is high volume. This doesn't directly confirm the current trend of the market here. So it can easily be that high volume can reverse, but not particularly directly relate to a reversal in the market, okay? So it's important that if we're going to go up and there is extremely high volume and we reverse price here, this could signal a manipulative move to the upside followed by a strong heavy reversal to the downside here. So the trend confirmation of high volume to the upside means we're bullish is not always the case here, okay? Pay very close attention to the overall structure of the market. We're going to give you a couple more examples later on. Then we have volume versus price movement, okay? High trading volume does not guarantee significant price changes, all right? So when there is high volume in the market, and this is maybe the most important misconception about volume, is that when people think that there is high trading volume and they visualize high volume in the market, they automatically visualize a massive, significant price movements in the market, which is absolutely not the case here, okay? You can be in a consolidation range, and we're going to show a couple examples where this is the case here, but you can be literally in a range doing practically nothing, yet there is a significant amount of volume activity in that range happening, okay? So there is a massive difference here between volume and price movements, okay? It can easily be that there are a lot of big sellers selling and at the same time, a lot of big buyers are buying. So that keeps the price obviously neutral, right? When big sellers and big buyers enter the market simultaneously, that doesn't mean directly that one of them is going to win and therefore that we're going to see a significant price move as long as they're constantly buying and selling towards each other. That's how it goes here. Okay, it keeps the price neutral. So it's important to mention that high trading volume does not guarantee significant price changes, even though you might think this is the case here. And this is going to be a key factor of what we're doing here and how we're trading the markets here. By understanding the fact that we are looking at high trading volume nodes, high trading price levels, where there is a significant amount of volume traded here, yet that is not directly visible on the naked eye. Whenever you look at a candlestick chart, you just see a candlestick chart. When you look at volume and you understand volume, this is like having an X-ray vision now, because you suddenly can see where the most activity was at what particular price level. But you will figure this out yourself. It's going to be extremely incredible once you discover how extremely powerful this can be. So the last one I want to talk about is the over-reliance on volume. Okay. Volume is an indicator amongst other instruments. It's not a standalone predicative tool. There are a lot of other ways you have to look in order to execute a trade position, in order to enter the market safely, securely, applying good risk management, trade management, and of course, waiting at the right moment, at the right time for your entry in order to benefit from your X-ray vision, to benefit from what you're seeing here. So relying on just one indicator, which we're going to talk about a lot here, it is not a standalone tool, right? It is a massive, massive factor. It's going to be extremely useful and we're going to utilize this a lot here. But in order to turn that instrument and that tool into a profitable trading strategy, we need to understand much and much more. That's where LTA Concepts comes into play here. So do not think that LTA Concepts is just a single volume profile and a single tool. It's much more than that. It's a complete understanding of how to turn a tool and utilize a tool and turn it into a fantastic, profitable trading strategy here without just focusing on a tool standalone. Okay, very important. There are a lot of more things needed and necessary in order to turn this into a profitable strategy. A lot more variables you need to know in order to get this sorted. Okay. So let's talk about volume and price versus volume and time. Again, there are massive differences between volume and price and between volume and time here. Okay. So let's talk about price volume first. Price volume measures the amount of trading volume at specific price levels. All right. So it looks at these levels. It looks at certain levels in the market and it understands exactly throughout that level on a specific amount of time here, throughout that level, how much volume has been traded. All right. It's used to identify price points with significant buying or selling interest. It's actually very similar to horizontal support and resistance levels. The only difference is that this is based around facts. It's not a subjective argument. It's not, oh, maybe it's going to hold here because we have been seeing multiple touch points into this level here, so maybe it's going to hold now. No, it says this is the amount of volume traded exactly at this price level. This indicates a significant more interest from traders at that level, and therefore when price gets to that level, there might be more interest and more trading opportunities for us as well to look at in order to execute. Okay, so what it in essence does, it helps traders visualize where the market perceives value or resistance. Okay, so it's super key to understand the fact that, what it does here in understanding price volume is that price volume practically equals interest, and that interest can lead towards trading opportunities. When it comes down to time volume, okay, you can see that overall, when talking about specific time, measures trading volume over a specific period. All right, so you could say this is the volume traded of one particular day. It doesn't necessarily reflect towards a specific price level. It just gives you an understanding of how much volume was traded. Could be a specific hour, could be the last 5 minutes, it could be the last 5 days. Whatever the case may be, whatever you select here, whatever you want to know is you want to compare the difference between volume between an hour, a day, a minute, you name it, in order to get an understanding of, okay, there's significantly more trading, more volume traded now than it was 5 hours ago, okay, which could benefit you with some trading opportunities. Also, when the volume tends to decrease here, so that's completely different from price volume. Time volume measures the volume over a specific time period. It also indicates overall market activity and liquidity during the period as well. This is useful. You can utilize this. I mean, more volume in that manner, specific time volume could result into more liquidity. But again, once again, you have to understand that it's not always necessarily the case here. It's useful for understanding the time-based distribution of trading volume, right? So again, how is the trading volume spread amongst the last 5 minutes, the last hour, the last day, the last week, the last month, and how does this compare to the previous, structures, the previous months, and so on and so on. Of course, this is typically displayed as a vertical bar beneath the price chart. So where we utilize volume profiles on specific price levels, which usually reflect a horizontal chart, usually time volume reflects a vertical chart. So this is an example of how the volume profile looks like, whereas this is, of course, an example of how a time volume stamp looks like. All right, the differences between time, you can see that every hour, more or less volume was traded at specific price nodes, whereas you could see this also in the volume profile chart. The only difference is this has to do with price and specific price levels. The combination of both is where the magic happens. So the combination of both is where we can utilize and how we can benefit from it here. Okay, the combination of both here is going to also help you understand exactly what the key levels are you need to look out for. So this is going to be a major factor in your trading journey with this specific trading strategy. And especially when utilizing LTA concepts, it's important that you understand the differences between price volume and time volume as well. Why volume analysis is considered the pinnacle of trading strategies. And this is, again, my personal opinion. You can have a completely different strategy. This is my overall understanding of the markets here over the last years. And this is my conclusion based upon the people I've spoken to, the profitable traders I personally know, and the research that I've done over the last years here. So very important. Number one, volume analysis is based on actual trade quantities, providing concrete data rather than subjective interpretations. So we can talk all day long about, all kinds of different indicators, right? And how this momentum and this price level and this could hold, you name it, or this specific order block, or this imbalance in the market, or fair value gap. But again, when it comes down to volume analysis, this is actually based on trade quantities, on the amount of contracts traded at specific price levels. So therefore, there is no theory, right? It's no conspiracy that 500 contracts were traded at a specific price level. It is not a conspiracy. It is an actual fact. Therefore, I like to work with that concrete data. The more concrete data I have, the less I personally have to worry about the maybe or the what if. And also do understand that a lot of traders still trade just on the candlestick chart. We call this level 1 data, right? Level 1 data is the candlestick chart. It's just, bullish bars and bearish bars. And we can work our way around it, and we can utilize it properly with understanding how the candles form, how the structure is built, and you name it. But there is always that missing link, that one thing that I needed to know. And the volume analysis solves this major issue for me on the first level 1 chart. All right. The level 2 comes down to, the depth of market, the footprint chart, the heat map, the clusters. All that stuff is going to come later on in the advanced section later on. It's going to be a major upgrade, a major add-on towards the LTA concepts, series and everything we're going to build up here. However, when coming down towards, my first argument, my first point here, it is based on actual trade quantities rather than subjective interpretations. And this is a major deal when trading and utilizing volume in the market here. Automatically, it's less vulnerable to manipulation, okay? So unlike some indicators that can be influenced by speculative actions, volume provides a more robust measure, and it reflects genuine transactions in the market. So therefore, automatically, of course, you can, try to avoid, manipulative moves here based upon the fact that if you can confirm that there is high interest at a specific price point and it's a protected area, and we're going to talk about protective ranges a lot here, then you will see why in this case, it can really avoid a lot of these type of manipulations here. It can avoid, all right? It's not a guarantee. It can help you tremendously with reducing the chances that you're going to enter and the market fakes out and it turns directly the other way here. It happens. It happened on stream. It happens all the time here. Yet, we're going to make, or we're trying to reduce the actual outcome of it happening, too much. All right. We want to make sure that we minimize this as much as possible throughout our trading journey, utilizing the LTA concept. So very important. The historical consistency, of course, number 3. We've all seen over time that these type of patterns, have shown a lot of consistency. All right. So when it comes down to these key levels based on historical price action, this is something that you have to discover yourself. This is something that I can tell you, but again, you have to backtest this in order to get a proper understanding of it. I really want you to understand it yourself. I really want you to make sure that you understand exactly what is happening here. And therefore, the only way to come to that same conclusion as what I did is by actually testing things out for yourself. Go into the charts, go back as much as you can and test each and every single one out in order to come to that same conclusion. And I can guarantee you, once you do, and you do it the right way, you will probably see a lot of similarities, a lot of patterns that you have not seen before, which you're going to discover and therefore automatically look at when price does something similar. We all know the saying, the market does not do the same thing, yet it does rhyme. And that is a fact. So the more you're backtesting, the more consistency and effort you put in to going back to the charts here, analyzing the volume, doing your volume analysis, and coming to these reliable key levels here based on the historical price action, the more similarities you will see and the more trust you will build based upon this trading strategy and this approach. And the more and clearer it gets when you're starting to see similar patterns occur in the market. And this is how you train your brain. You train your brain by getting familiar with similarities. You've seen this before. And after a while, you're like, hey, I've seen that one before. I've seen the pattern repeating itself here. And the only way to learn this is by either backtesting a lot and taking this extremely serious, or putting and implementing a lot of time on the live markets in order to get an understanding of what's happening and how these particular levels are respected here. So put in the work and you will see that these key levels are extremely consistent as well when doing your volume analysis. Now, when it comes down to commitment, okay, high volume indicates a strong commitment for traders, suggesting a more reliable trading opportunity around that level. So in essence, it comes down to, and this is the exact reason why we call our ebook the Trading War Map. It's because there is just a constant war going on between buyers and sellers. When you're coming with your troops and you're trying to take over a certain amount of land and you're marching forward until you come to a certain gate, a gate where there are other troops protecting that gate from you entering. That's what's happening with sellers and buyers. When buyers are entering, coming in with their troops, marching forward, pushing price up here, there are sellers waiting at a front gate, protecting their land, making sure that they're safe, that they're protecting their territory by putting and preventing a certain level. That's what's happening. When aggressive buyers step in, aggressive sellers are defending certain levels. What we want to do is where is the most interest around these levels. In order to gain an understanding of interest, we can directly understand and highlight where the actual war takes place. And then it comes down to our entry models. Then it comes down to waiting patiently like a sniper, understanding that it's better to play this game smart and patiently rather than trying to go in aggressively, trying to win that battle, whereas it's much better if you wait for, in this case, the sellers to be much weaker, waiting for them to potentially push price through. Or if buyers are not able to, continue moving forward here, marching forward, and have to pull back due to the fact that there are too many aggressive sellers defending a specific position here. So high volume indicates a strong commitment for traders. Strong commitment from traders indicate better and more reliable trading opportunities and also automatically more liquidity. This equals, of course, fantastic price action that we can take advantage on. And if we can put a little bucket below, we take advantage of that situation. So very important. Now, let's talk about the fixed range volume profile. This is our tool. This is what we're going to use a lot here. We have a couple more volume profiles that we can implement here. However, we're going to specifically talk about the fixed range, as this provides you with the same information, everything that you need to know here, and it helps you with identifying particular levels at specific periods of time here. So we're going to talk about why some brokers restrict access to volume data. And this is a major factor, and this is even more important in the Forex market. This is less relevant for futures traders. When you're trading futures, you get access to centralized data. It's much easier to get access to a lot more information. You will have to pay for it in many cases, but there is an unlimited amount of availability of that information. When it comes down to Forex brokers, it's usually much more restricted, yet definitely still possible. And I will give you an examples of which brokers on the TradingView chart we will using due to the fact that it's, has been proven to work based upon our historical practice with this indicator here. So very important, why some brokers are restricting access to the volume data. So we want to make sure that you get access to this information and that you're not stuck with not being able to utilize this tool, as it can massively impact your overall profitability utilizing this strategy. So what is the fixed range volume profile? Okay, how to analyze it, how to draw it, what it is, the technical side of it, the settings, everything that you need to know are going to be in there along the way. Also on TradingView here, we're going to talk about the point of control and the value areas. There's a massive difference between the point of control and the value areas here. We're going to talk about both of them. And then we're talking about how to set up the fixed range volume profile properly on TradingView. So with that, you should get a proper understanding of how to utilize this tool along the way here. Okay, super key. Now let's start with the brokers and why they're restricting you access to the volume data here. There are a couple of reasons why. You will never find out the true reasons why. They will know. We will never know. Well, we came up with a couple of reasons why this must be the case here. So, number one, for broker-specific data, okay, that indicates that the volume data the brokers collect is often a reflection of their own clients' trading activity and not the entire market. This, again, is important for my Forex traders out here. Okay, what you're in essence doing when you are trading with a Forex broker, you're utilizing a contract built on a contract. That's what we call the CFD here. Therefore, again, that's the difference in spreads, and that's why you have to be extremely aware of the fact that you want to work with the right broker, a regulated broker that is active and is reliable for a long period of time, and that's actually providing you with the information here. So some brokers may may choose not to provide it to avoid misinterpretation. Okay, so it's true with smaller brokers. Okay, smaller brokers usually do not have the volume necessary in order for you to utilize it properly, and therefore automatically, because they're smaller, this particular data does not reflect the actual information you need to know in order to set your levels. And that's why it's important to utilize it with the right broker, or at least utilize it on TradingView with the right broker while trading with your own broker, or whatever the case may be here. So it's, it could be a reason that they provide or not provided to avoid any misinterpretation. This is one reason, okay? I personally believe that it comes down to 2 and 3 here, okay? Collecting and maintaining extensive volume data requires significant resources and technologies. Smaller brokers might not have the capability to offer this service effectively. And then the last one is probably the real reason why they're not doing it, because they know that this potentially can give you that edge that a lot of brokers don't want you to have, because brokers, of course, obviously make a lot of money if you are a losing trader. Why is that? Well, what happens all the time in the markets here? They counter trade. They counter trade the losing traders. Kind of easy, right? You know that somebody is a losing trader. You can analyze him quite quickly based upon his trading behavior. And based upon his trading behavior, you can set in your risk parameters, hedge yourself, or potentially counter trade them to potentially secure yourself or make even a profit amongst them losing. So that's why it's so important here. So there are a lot of brokers out there with relatively bad intentions here. So therefore take consideration that you picked the right one. But in many cases, there are a lot of brokers out there, that will not provide you with the proprietary information, which giving you a competitive edge here, okay? So by withholding this data, they might feel that they are protecting their business strategies. And I think this is one of the major factors when it comes down to utilizing the volume profile, and especially when it comes down to decentralized information, which is, of course, on the Forex market. So therefore, pay very close attention to which broker provides you with that information and which broker does not provide you with that information, okay? That's why in many cases, you can always find a workaround by using other charts here, as long as the price is relatively identical to the price you get on your broker. Okay, the differences cannot be that big, therefore it will become automatically less confusing, and so on here. So that competitive advantage is a major factor. We have seen this a lot here, and I'm going to give you a couple of examples of brokers that do not support it and brokers that do support it, so there is no misunderstanding right there. Now, what is the fixed edge volume profile? To sum it up here, you probably already went through the ebook, you get a basic understanding of it, but just think of it as a trading heat map, all right? Showing the most active price levels during a specific period, like highlighting the busiest cities, areas on a map, right? The busier it is, the more interesting that place is apparently going to be, right? Otherwise, why would it be that busy? Another way to look at the volume profile, like I said here, is like before, we have a massive castle, right? And that castle is supported, is protected, all right? The more trading volume is around there, you can see directly where the troops are located here. So if you have a war map, you can practically see that the sergeant or the commander looks at his war map and he sees exactly where all his troops are located. Now, this is kind of what we're looking at. Okay, a trading heat map showing the most active price levels during a specific period. Very important too. So, key components, okay. Price levels display various prices on the chart, and the volume bars that you will see are the horizontal bars showing trading volume at each price here. Okay, there are a lot of different ways you can utilize the volume profile. We're going to go through all the different ways in the settings as well, so you know exactly what the differences are between price levels and volume bars, and what the right settings are in order to get exactly on the same page as how we from LTA Concepts are utilizing it. Okay, so why should you use it? It identifies support and resistance. It spots potential price rebounds or breakthroughs. So imagine this, you are a support and resistance trader, or you are a supply and demand trader. You are a trader that looks at particular structures in the market here. And what you're in essence doing here, you are looking for breakouts or you're looking for reversal plays. If you use volume as your main tool of reference, there are practically no more questions around it if this is the highest form of interest. If you draw and utilize the volume analysis here, then automatically you will start drawing your support and resistance levels without even have to know it yourself and figuring it out yourself and trying to guess from a candlestick chart if this is actually still interesting for a lot of traders here. I do agree with the fact that yes, when you see many touch points on a specific level on the higher time frame, obviously this is automatically going to be potentially an area where there is higher volume traded here. But most of the time when I'm doing my analysis here, you will be extremely surprised, or I was extremely surprised with looking at particular levels in the market, which I did not expect to see here. So there is no more guesswork. And it saves you a tremendous amount of time, tremendous amount of headache in that matter. So, finding market balance. Okay, it identifies areas with significant time and volume, indicating buyers-seller equilibrium. So that means that you can understand exactly where buyers and sellers were equally interested in trading at a specific level, which can help you with setting up the foundation of your trade, and therefore automatically with putting your stop loss at the right levels, and so on and so on. In terms of trading decisions, it provides with historical insights for predicting price movement. So when it comes down to certain ranges, certain swings, certain times of the market here, a full trading day or a full trading week, or one of these previous weeks here, there are a lot of different ways we can utilize this to get access to particular important key levels in the market based on the structure. And with that said, there are a lot of other confluences we can utilize or use here to get access to that information, to fine tune these areas of interest. We call these the point of interest for our trading setups. When to use it, okay? It can be extremely ideal for a post-event analysis or during market fluctuations, especially when there is, of course, more trading volume. The more trading volume it is, the higher the chance of a potential reaction from a level, the faster we get to a specific price level, and therefore because of these confirmations you are looking for, there is a chance that your setup can play out based on the high volume. When there is low volume, it can take longer, and therefore the setups that you're waiting for can also take longer as well here. So it all depends, of course, on how aggressive price is moving and how much volume is actually in the market at that specific moment of time here. Okay. However, at the same time, it's useful for both stable and volatile markets as well. When it comes down to a very stable market, you might be using and utilizing the fixed edge volume profile differently than when the market is extremely volatile here. And that's what we're going to explain you along the way here. The differences between trading in a stable market or in a very aggressive market where you see a lot of aggressive price move. Different ways we can utilize it and use it in our advantage when trading in both scenarios. So what I want you to be aware about is the difference between a stable market and a volatile market. I want you to be aware of the current market sentiment when you're trading here. Because what tends to happen is that you get very used to trading a certain way, and then the market shifts. It's completely different sentiment. The environment of the market is different here, and you're still stuck in that initial bias that you created for yourself based upon your strategy here. No, you are trained to adjust. LTA concepts is automatically utilized in order for you to get very snappy, very quick in your decision making when the market sentiment changes. So that's why it is such an important and powerful tool. Now let's talk about the point of control in the value areas. All right. We're going to come up with a lot of examples here on TradingView, but let's start out, of course, with the most important level here, which is what we call the point of control, the POC. And the point of control is a level that is guaranteed to provide you with a certain level where the most trading volume has occurred during a specific range. All right, a specified range based on your preferences. So you decide what that range is going to be, but it will give you the answer by showing you where in that range, on what exact level was the most volume traded. And you will see if you pick the right ranges or the right swings or the right profiles, you will see how effective these levels are and how they determine how price will move in the future as well here. So the point of control is an absolute necessity, extremely key in order to utilize it here. It represents the price where the most traders agreed on value, indicating a strong consensus or focal point in the market, right? That is the point of control. It's literally where, all eyes on, all the eyes are focused on, right? It's that focal point in the market where all kinds of traders, buyers and sellers, are looking into either buying or selling and executing their orders from. So that's a necessity. The POC is often considered a magnet for future price action because it reflects a balance point where buyers and sellers were most active. So the more you understand of how important it is to get familiar with levels that are interesting for a lot of other buyers and on other sellers here, the more you can put your legal bucket below here. The more you can start sniping the markets by just joining them rather than being all standalone by yourself, trying to figure it all out here. So the point of control helps tremendously. I always refer to a castle, and when it comes down to a castle, you always have that outer ring, and that outer ring is, let's say, the lake that's built around the castle, right? Protecting the castle here. This is what we call the value areas. We're going to talk about them in a second here. And the point of control is that big, massive gate, that gate where it's very hard to get into. That's the point of control. That's the most protected area, the most protected range, the most protected door and entry point in that castle. Okay, so let's talk about the value areas right now, because we have seen a lot of confusion about value areas and how to properly utilize them, but these are maybe the most important levels to look at in combination, of course, with the point of control here. So they consist of two levels around the POC. the value area high, or the VAH, right? And the value area low, or the VAL, right? The value area high and the value area low of a specific price range. So together, these define a range where a significant portion of trading volume occurred, typically around 70% of the total volume in the selected range. So what it does is you select a full range, and 70% of that range, based upon your preferences, you can change this up as well, but it's usually around 70%, it marks out the significant increase of volume of your overall range here. So if you select a certain range here, it highlights 70% of the total volume within that selected range. And that's key. The significance where price increases or volume increases is usually marked by either the value area high or value area low, based upon the way you select and utilize this tool. So the value area high represents the upper limit of this high volume range where buying started to taper off, and the value area low marks the lower limit where selling began to decrease here. So very key. Prices within the value areas indicate levels where traders saw the most fair value, whereas price outside of these areas are seen as the less fair value or more speculative. So that's super key here. You see an example here of the value area high, and you see an example here of the value area low. See both of these levels here as that lake, what we just talked about, of that castle here, that outside lake protecting the point of control. You can maybe conquer the value area low or value area high, but once it gets to the point of control, it gets very hard due to the significant amount of interest right there at that specific level. So the value area low and the value area high are these entry models, these entry ports here, still able to protect yourself from, any danger, any aggressive sellers or any aggressive buyers in this case here. And it can also hold as a significant key level in the market here. This is where the value areas come into play handy. Okay. Then it comes down to high volume nodes and low volume nodes here, because what I've seen a lot here when people start utilizing this tool properly, they only look at the value area high or the value area low or the POSC here. But what is important for you is to also understand what high volume nodes are against these low volume nodes. Okay. High volume nodes are price levels where a significant amount of trading volume has occurred. These appear as thicker, longer bars on the price volume chart here. Okay. They indicate price levels where market participants have shown strong interest, often leading to the formation of support or resistance levels here. These areas can be as zones of comfort or value where price tends to consolidate or linger as participants agree on price here. So as you can see here, this is the full on fixed range of a specific range here. And you can see that there are significant more bars built up around this particular zone right here. Much more volume traded around that level here, right? The bids, the asks, you can see right here, there is a significant amount of volume traded here. This does not directly mean that this is the point of control. Of course, the biggest point is the point of control here, but again, where the volume starts to increase is also already where you have to pay very close attention. So it does not necessarily mean that you only have to look at the point of control here. No, you have to look at every single bar to understand the differences within the whole range here. Where are the high volume nodes and where are the low volume nodes? Okay, let's talk about the low volume nodes here. Low volume nodes are price levels where very little trading volume has taken place. These appear as thinner, shorter bars on the volume profile. They represent price levels where there was relatively little interest or agreement on value among market participants, and price tend to move quickly through these areas due to the lack of significant trading activity or interest, potentially leading quick to sharp price movement as price seek out levels with more volume and consensus here. So you could see this as the imbalances, which is an actual fact in this case here, and therefore it's easier to slice through it like a piece of butter here, as well as when, or as opposed to where there is significantly high volume nodes here. So usually you can look at these type of gaps here, okay, and it's sometimes extremely useful to, for example, put your stop loss underneath high volume nodes rather than low volume nodes, because if you put your stop loss right into a low volume node, it might be easier to get there, and it's maybe better to protect yourself from low volume nodes by putting your stop loss into or underneath high volume nodes to protect you from a particular setup here in case price goes against you. But this is something that you can utilize here. So rather than only looking at the value area low and the value area high here, okay, I also want you to be aware of these high and low volume nodes here. That's in essence the true essence of the fixed range volume profile and how to use it properly. Okay, so let's go to the next phase here. I'm going to go to training viewer. I'm going to go exactly explaining you how to set up the fixed range volume profile properly, what are the necessary settings are, and how you can truly optimize this tool in order to set the framework and foundation throughout this whole series, giving you the right setup in order to move forward from there. Okay. So with that said, welcome to the trading view chart here. It's important for you to understand that you can utilize this specific tool on multiple softwares. It is not a necessity that you utilize TradingView. There are a lot of other opportunities and tools out there that you can use, especially when trading futures. But in this case, we're using TradingView as our main tool of reference for our volume profile analysis. Okay. As you can see, I'm here on the Owanda chart here. The Owanda chart is providing me with a lot of really solid information and usually utilizes the volume profile the right way. This also counts for FXCM and Pepperstone. These are all the brokers I've been working with and have been testing this with. And so far, I got a really good response from it based upon my backtesting and my live trading execution series. So I highly recommend you to utilize either the Wanda chart, the FXCM chart, or the Pepperstone chart, but it all comes down to your personal preference, of course, as there are many brokers out there. Now, what we're going to do is we're going to look at the volume profile here. And the way we're doing it is we're going to head into this section. And we're going to go to this part right here, which shows you, in essence, the volume-based section where you can select a different type of tools here. The anchored volume profile, the anchored VWAP, and in the middle, you can see that the fixed range volume profile is there to find. So one more time, you go to the projection section here. Usually you will find, your long or your short there as well, your short position there. We're clicking on the fixed range volume profile. And when you click on it, of course, nothing happens. Why is that? Well, you will need to select a certain range in order to get the information from. So let's imagine that we are now seeing a complete range right here. This is one big range, and we're going to talk about all the different types of ranges, swings, and all the different ways of you can or how you can utilize the fixed volume profile. But in this case, I'll show you just the settings of it so you get a clear understanding. So we're going to click on this tool right here, and we go from the left. This is where the starting point is, and we're going to go to the right, and we click on the right here, and boom, directly you can see that the default section of the fixed volume profile pops up here. Okay, we talked about the value area high, that's right there. We talked about the value area low, that's right there. We talked about the point of control. The point of control is right there, that red line. You can see directly, by the way, how that touches into that level and it goes up from there. Just an interesting observation. But anyways, this is the foundation you have. These are the row sizes right here, okay? Showing you, in this case, the bids versus the asks, the buyers versus the sellers. And it gives you the identification of where the most volume has been traded and when there is lesser volume traded throughout your specific range, your selected range right here. Now, of course, you can see that you've only seen a couple of bars here, so we can count them. We're seeing 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6. So when you look at the settings here, you can see, oh, sorry, it's actually 24. Need to count a little bit better. However, it's a 24 row size, all right? And what in essence happens here is that you can decide based upon your preference how well you want to divert the row sizes here. In essence, what it does, it just gives you more specific information. So the higher, the more rows are getting created, and based upon the more rows that are getting created here, the more specific price action you get in regards to the information of each particular level. So the thinner, the more precise the levels, the more precise the actual outcome is of what you're looking for. So what we're looking for is a 128 row size. This is what I personally use here. Again, this is all personal preference. There is not a right, there is not a wrong. For me personally, this is the way I like to do it here because it gives me a very nice overview of where there is a lot of volume traded and when there is a slimmer amount of volume traded here on this specific price range. As you can see here, clearly the high volume nodes are sitting right there, right there, right there. And the lower volume nodes are sitting, of course, right there, right in the middle. You can see also there and of course there and there. You can see that there is much less volume traded at that specific price level. Therefore, you can see clearly that there's less of an impact. Whereas around the area where the most volume has been traded, right, the point of control, you can see a significant more interest traded around that specific level here. So that's why I personally like to put my row size at 128 to give me that extra information. When it comes down to the value area volume, I usually leave it at around 70%. Okay, once again, it shows you the complete range, the highlighted 70% where the most volume has occurred here. So the sudden increase in volume happened right at the value area high here. And when you draw a trend line on this value area high, you can already see directly how we responded after this level as well. Same for, of course, the value area low. We talked about this one before here. You can see also how we are responding around the value area low by default already when looking at that sudden increase of that specific level here. So that's what I personally utilize, the 128 row size against, there we go, let me go back here, 128 row size against the 70% area volume. Now there are a couple other ways you can change your layout here, okay? You can look at the number of rows, you can do ticks per row, all right? The only thing that it shows you differently is just more of a wave of the way it's shown. Overall, I've noticed that there is not a significant difference in in outcome when you change it up to ticks per row. I just utilize the number of rows in order to get what I need here. Okay. Then it comes down to the volume, and this might be interesting here because there are three different ways to look at it. You have up and down, bid and ask, potential buyers and sellers executed. Okay, bids and asks right here. You can see the differences between both. All right, we call this the up and down range. Then we have the total. Right, this removes the differences between buyers and sellers, between the bid and the ask here, and it shows you just the total volume of both. All right, this doesn't give you the necessary information of the differences. It just shows you the total volume traded at a specific level. Then we have the delta. All right, and the delta shows you with more clear precision what the net difference is between buyers and sellers, between the aggressive buyer and the aggressive seller. In essence, you can see on each specific price level which area or which person, which seller or buyer is actually in control here. Are sellers in control at this level, or are buyers in control at this specific level? The net difference between these aggressive buyers is the delta. All right, you can have a positive delta. This is where buyers are in control. You can have a negative delta. This is where sellers tend to be in control here. Okay, what we're utilizing here is to simply the basics, the up versus down. This is in essence all I need to know here. The total amount, and you can kind of already see, the amount of buying that took place around this specific level. Okay. At the same time, when you look here, you can always say extend right. I recommend you to put this off here, as it can give you potentially the wrong information, as of it not turning into a fixed range anymore, but it just gives you the overall range all the way till the end of price here. It can be useful for when you draw a range specifically and you want to highlight it until the latest point in the market, the current price. That's the only way where you can use it. And for example, a current weekly POC or a current weekly range, which we're going to talk about in the next videos here. But I highly recommend you to just turn this off to keep it more specific based on the range that you select here, as is that's the information that you want to know in order to move forward here. That's the inputs. Now let's go to the style here, okay? Obviously, you can select the value area high yourself and the value area low. It will pop up and you suddenly see these two exact levels also appearing here. So it's always personal preferences if you want to actually look at it and utilize it, or if you do not want to utilize it at all, you just want to use it separately with your own, for example, horizontal rays here. This is what I personally like to do here. I like to utilize it this way, and then based upon all these different, glossaries right here, right? These analogies you can use and say, okay, this is where, or this is the level that I'm going to use here. And I'm just going to save it as a template and just paste it on my value area low. It's personally what I like to do here, based upon the extension. And that proves that I don't have to then eventually just like select it. And then it's not extending, right? Unless I extend it myself here. But that's not what I'm looking for, because then it changes automatically also the distribution of the fixed range volume profile. Okay, so very important. I said analogies. I obviously meant the terminologies right there. Okay, as we have many different terminologies we're going to use over time here when you save all these type of templates. So when coming back to the style here, there's something very interesting. Okay, and that is what we call the values section. And we can turn it white here, for example, and it shows you the values within a percentage of the box here, and it's on the left side and nothing changes. At least this is what you would say, that nothing is changing. But what you do here, and this is also optional, is that when you start zooming in on these exact volume nodes here, now you suddenly get information. And that information is what we have been talking about here. It's the bid versus the asks, right? It's the amount of contracts executed at a specific level, the amount of contracts that were bid, and the amount of asks at that specific point. So for example, here you can see that at this specific level, at 21.59, which is the point of control here, we saw a 12.15K bid and a 12.80K ask, all right? Therefore, showing you that there was a significant more interest at that level in comparison to the rest of the market here. Now, we're not going to go too deep into each specific number here and what it actually means and how you can utilize it here. But what we're looking for is the bid versus ask here. It's going to be much more appealing and interesting when we're trading and utilizing the actual level 2 data on, for example, the footprint charts. For now, what we're looking at the most here is just to get an understanding of the fixed range. So the value is or potentially are interesting to look at, especially when you are going into the gaps, right? Into the low volume nodes here. You can see directly the differences between the buyers and sellers here, or you can also look at significant differences between buyers and sellers as well. Sometimes you can see a more of a difference. For example, you can see that much more buying appeared around this exact level at 21.57 against the sellers here. Right? Much more buying activity took place than selling activity right around that level. So that's why you can utilize the values section. I usually have it marked up here because I do not really find it extremely relevant, because I can see all the information right here. If you want to have that information, you can definitely look at it and utilize this in your potential way possible. Okay. Then we have the visibility. Okay. If you say this is on the 30-minute time frame right now, and you say, okay, I want to have this removed on the hourly, then what tends to happen if you go to the hourly here, you tend to, for example, let's go back. Let's go to our tool. It's gone, right? It disappeared. So again, That's what happens when you utilize the tool here and you select it for the hourly. Then obviously on the 30-minute, you're going to see it once it pops up again, whereas on the hourly, it disappeared. So it's also possible for you to just remove the visibilities. You can remove the months, the weeks, the days, and only have it visible on the specific time frame you're looking at here. If you use it on a specific time frame, you can select it for that specific time frame, and you can remove it on any other time frame if you want to. All right, this is all optional. So I hope you get a good understanding now of how to utilize the fixed range volume profile. Why we're looking at a 128 versus 70% row size here. You can play around with the value area volume. I have noticed that between 70 and 72 is for me perfectly fine and is working exactly as of how it should be. 70% of that specific range or information is used in order for us to get an understanding of where the most volume has been traded here. Specifically, it's kind of a compressed version of the fixed range volume profile, which is highlighted, and therefore we want to make sure that we understand where that sudden increase begins. And this is, of course, where we use the value area volume tool for. Okay, so again, you can utilize it in your way possible here. It's all optional. I have created my own version of it right here. Okay, so the 128 against 70 ups and downs, and of course the number of rows instead of the ticks per rows. But in essence, this is all optional for you to use here. So with that said, we will be ending the first official introduction video, setting the absolute basic foundation and framework of LTA concepts, of the reasons why we're utilizing the volume analysis here, why we believe this is such an extremely powerful way of analyzing the market here. We also talked about how to set up the fixed volume profile so you get a clear understanding of how everything works. So we actually set up everything perfectly so we can now start with the real stuff down the road within the next coming videos ahead of us here. Okay, so a quick summary. We talked about the definition of volume. We also talked about the misconceptions about volume as well, because apparently there were a lot of misconceptions about what volume actually is and how it's actually used and utilized in the markets here. We talked about volume and price versus volume and time, as there is a significant difference between both volume and price and volume and time here. However, we will still be using both of them a lot, especially volume and price and volume and time. So not particularly volume and time, sorry, volume and price and time, all right? So we're utilizing specific time periods to get a very clear understanding of what the amount of volume is traded during that specific amount of time at specific price levels in the market here. This will make sense down the road. We also talked about why volume analysis is considered the pinnacle of trading strategies. Why are so many institutional traders utilizing volume and volume profiles in order to make incredible trading decisions based on these particular variables, these metrics they use and implement here, all built around volume. And then we talked about how to properly set up the fixed range volume profile in combination with the understanding of photo control, the value area volumes, high volume and low volume nodes. So in the next video series or the next video of our series here, we're going to talk about two things. Number one, the limitless LTA concepts, session breaks and Sunday open indicator, which is an absolute necessity for you to utilize here when working with our LTA concepts strategy, as you want to make sure you are extremely efficient and clear when utilizing this tool here. Again, saving you a lot of headache, a lot of time. Again, this is a free indicator in our Discord. You will find it if you look for it, and you can easily get access to it here. But it's important for you to utilize this tool. This will help you tremendously overall with doing your day-to-day analysis here. Based upon that, of course, we're going to use and we're going to go to our first official key level, which is going to be the Sunday open. All right, the opening price of the week. We start the week strong. We start with the understanding of the opening price and the previous opening price. We call this the SO and the PSO. Anyways, you will know exactly how to properly utilize this down the road. In the meantime, it's important for you to do your homework here to set everything up perfectly. Make sure you backtest, you get familiar with the tool. You went through the ebook already. You should have already a basic understanding of what we're going to talk about and discuss within the next coming videos here. I want you to be aware of the basics, have everything set up here, become familiar with the Fixers 1 profile. With that basic understanding, we head into the next session. And this is how we start the week together, starting, of course, with the Sunday Open. So far, if you have any questions, make sure you ask anything in our Discord here or in our Discord regardless, all right? An incredible community. We're here to help you. Make sure that when you ask something, that you are very precise with your questions and we get back to you as soon as possible, making sure there is a significant amount of clarity coming back towards you right there, okay? LTA concepts, first video done here. Let's get into the second video of our video series, Sunday Open. Looking forward to see you there.